Welcome, everyone. Welcome to the year-end 2021 LePoidevin Group conference call. Quite a year. In fact, I think in the 35 years that I've been around in this business, it's our best single client year. And, I want to thank everyone as well for our Globe and Mail accolades in our Globe and Mail ranking, and some really lovely emails. And it's once in a while, it's nice to be recognized. So thank you very much for that. This is the year that we get rewarded for being patient last year and going through some kind of gut wrenching. I mean, it's our money, it's our livelihood. And in 2020, you guys kept the faith, and we kept, we looked at the history of pandemics, and we also have a rule, which is money has to go somewhere, and we know we don't fight the U.S. Federal Reserve, don't fight the Fed is the old saying. So at the end of the day, this year is the reward for staying the course. And depending on your age and your client base, but it's into in some cases into the 20s in terms of rate of return. And so we are very, very pleased with that. Okay, so year to date, I mean, it's not year end, but it's a few weeks away. So we just kind of summarize where we are in the markets. So for those of you who've telephoned in, don't worry if you can't see the slides. I'm kind of going to go through them, but if you've zoomed in, there's a little bit of visuals going on here. So Dow Jones, which is the 30 stocks, generally the largest US companies, 16.5% from Jan 1. The S&P 500, which is 500 market capitalization stocks at 24.9. The Toronto Stock Exchange at 20.7, exceptional year for Canada, which has been lagging. The NASDAQ, which is the technology, which is the over-the-counter, actually, not New York Stock Exchange, but over-the-counter index, which tends to be focused in on the high-tech sector. It was 17.5%. I like to talk about, indexes are indexes. I mean, there's a lot of them out there. So the Value Line Index measures just actually 3,500 stocks. What's the average return? And they're unweighted. So a Dow or the S&P will take the biggest companies and give them the highest percentage weighting. The Value Line just says, oh, what's the average stock? It's still up 17.5. The EFI index is Europe, Asia, Far East index, was actually a massive lagger. We usually don't see those kind of deviations, 8.1%. So this is everything outside of Canada and the United States, is the rest of the world, 8.1. Emerging markets, minus 2.8. The bond market, this is Canadian bonds, minus 6.4, and the preferred iShares index, which is not picking, just owns all of them. iShares preferred 11.8%. So that's kind of a nutshell where we are. And I'm going to kind of point out some idiosyncrasies within the market. So I'm going to kind of go through a popular myth. And that popular myth is that the way to get wealthy and the way to get good returns is through, new technology and these very, very sexy names. I call them headline names. And headline names are the things that if you're a retired guy and you're sitting at home and you're watching the financial news on BNN, Business News in Canada, or CNBC in the United States, there's a lot of attention-grabbing new companies. And this is the index itself, which did 17.5. But within that index, it's actually a lot of investors in technology have had a terrible year. Now, this is really, really good news for us, because we've talked about clients calling in, they say the market's a bubble. And within that bubble, they were looking at some of these outrageous evaluations for companies. And the good news is, especially in the last couple of months, a lot of these companies have blown up. And the good news is, this is not like 99 and 2000. Like I've tried to reiterate in these calls, there's so much value in the market, and yet people sort of gravitate to new, exciting things. So if you look at, for example, Zoom video, from its high, I mean, we're on a Zoom call. So, we pay for it. It's a great business and it's new. But unfortunately, if you sort of jumped on that bandwagon, you're at minus 55%. A new company that already hit the index is in the NASDAQ index itself. Robinhood is that free trading online website that a lot of young people are on, minus 58%. Remember the Beyond Meat, the new phase, tastes like hamburger, but it's better for you. Minus 67 if you bought that when it was hitting the headlines. Peloton, remember everybody at home is buying this $4,000 bike, and you pay $70 a month, and you don't have to go to the gym. Made a whole lot of sense, hitting the headlines, minus 71%. The poster child, Nikola, electric trucks, everyone trying to buy the next Tesla, minus 85%. So be very, very careful. This has not been a good year for technology. So one of the hot new funds, and this is an exchange traded fund, but it is basically a mutual fund. It trades on the New York Stock Exchange. Cathie Wood's ARK Innovation Fund. It was up over 100% last year because it was all the new stuff that was working during COVID. These new technologies like Peloton and things, and Virgin Galactic minus 71%. This is the Richard Branson company that's taking people to outer space. Very, very exciting, but not a great new theme from investing. So the ARK Innovation Fund unfortunately attracted most of its assets the year after it was up 100%. And year to date it's down 19.2%. This attracted $6 billion in the first 6 weeks of the year. So you can see the fund at the beginning of the year was up 15% or 20% in the first few weeks as money just poured into it. It's minus 35 from the peak, minus 19 from the low. So it's been actually not a good year for that. The other area that I'm talking about at the beginning, fortunately, we've avoided these couple of sectors. One was new theme technology, and the other one that we really have a zero weighting in is the bond market. And we've been talking about this for some time. And I have a quote here: bonds are investment garbage, just like cash, Bill Gross says. Now, Bill Gross was the largest manager on the planet of bond funds. So he ran the PIMCO, which is Pacific Investment Management Company out of California. He had more assets than anybody else, and he was called the bond king. He's now retired. So rather than, trying to pump up bonds, he's actually, Bill, how do you really feel? And when he's talking about investment grade garbage, as I showed you, if you bought the index on the iShares, you're at minus 6% for the year. And let's just talk about the mechanics of bonds. And again, one of the things we try to do at LePoidevin Group is avoid really bad investments, and really, we don't like losing. So what this shows is 1 year ago, a 5-year bond yielded 0.5%, and a 10-year bond yielded about 0.75%. And what happens when interest rates start going up? Now, if you can see on the curve, this shows a chart of zero term, like a 1-day rate, out to a 30-year rate. And that curve is upward sloping to the right, as it normally is. And a year ago, if you bought a 30-year bond, that was the best rate available at about 1.25%. And if you look today, the bond market is now beginning to anticipate then interest rates are going to go up, because even though the Bank of Canada has not raised rates, a 5-year bond in Canada has gone from 0.5% in the last year to 1.5%. A 10-year bond has gone from 0.75% to 1.5, a little over 1.5%. And it's interesting to know that 70% in a survey done not that long ago, 70% of investors did not know that if interest rates go up, bonds go down. Now let's think about this for a moment, and I'll just go through the mechanics of why you lose money if interest rates go up. If you bought a piece of paper that was a bond a year ago at 10 years at 0.75%, you're guaranteed to get the 0.75% every year for 10 years. So if you put in 10 grand, you get $75 a year. The problem is, if you went to sell that bond today, you now have a 9-year bond. And if you go to sell that, no one is going to buy it from you, because they say, well, why would I buy from you at 0.75%? But I can get double the yield going out in the open market. So if you need to sell that bond, you're going to have to entice investors, and you're going to have to sell that bond at around 94, 95 cents on the dollar. And so you're going to have a negative return in the year. So it's one of the things that I've come across with a couple of clients is, oh yes, well, David, good year, that's great, but the markets are doing well. Isn't everybody doing well? So I actually did a little bit of homework, and sometimes I surprise myself when I do some of these sort of homework assignments, like the pandemic experiment, which we look back on history. The other thing that surprised me is, where's the money? So we went, the vast majority of mutual fund money, which is, it does it for you. You buy a fund, they're going to buy the stocks, they're going to buy the bonds. The vast majority is sitting at banks, and the two biggest banks in Canada are the Royal and TD. So I've outlined the top 10 biggest funds in this country, and they're actually, no surprise, but it wouldn't be any different if you looked at BMO's funds or CIBC's funds. These are just the 10 biggest. So if we looked at the RBC Select Balance Fund, which there's an incredible $60 billion in that fund, did 8.3% for the year. The second biggest RBC Conservative Fund, 5.6%. The third biggest RBC Bond. Well, it isn't that different than the index. Interest rates have gone up. The value of the bond's gone down, minus 5.4%, and so on and so forth. TD's biggest fund that they have in their entire outfit is the TD Bond Fund. Couldn't lose. It did very, very well in 2019 and 2020 as interest rates went down. Unfortunately, if you bought in the throes of the pandemic, which it was doing fabulous, that was a poor time to buy. So the incredible thing is that Canadians have decided that they have more exposure to the bond market. By the way, there's just in those 10 funds, there's about $300 billion. So that is an incredible amount of the wealth in Canada that did 1.9%. And the Canadian public's exposure through these funds is roughly 60% bonds today and 40% stocks. And if we look at the currency, they're about 80% in the Canadian dollar and 20% in the US or foreign. The good news is we don't have any bonds, because at the end of the day, I did not want to make a bet that 10-year bonds would not go up from 0.75%. Let's talk a bit about again, so this is sort of the year in review. It's a timely call because it's year in review, but we also have another couple of things that are going on. And one is this new COVID variant, which began to spook the markets in the last 10 days or so. And we also have the US Federal Reserve Board, which is now admitting that they have taken out the word transitory in their language of what is happening to inflation and where they expect interest rates to go. And if you remember, one of the things that we talked about in the throes of the pandemic is Jerome Powell, who controls US interest rates and money supply. They had dropped rates to zero. And in an interview in 60 Minutes, he said, well, we are just printing money. And that money supply is up about 35% since pre-pandemic. And, you know, again, this money had to go somewhere. And what they're indicating now is that they're going to lessen the rate of printing, which is buying bonds in the open market. And the market kind of went, whoa, okay, so you're taking your foot off the floor of acceleration in terms of pushing out loose money. The other thing is that all this money printing is actually leading to inflation. We had a US initial jobless claims. These are people filing for unemployment. It's the lowest level in 52 years, which is incredible, because not only is it a 52-year low, that's not population adjusted. This is an actual number. We have a labor shortage not seen in the history of maybe since the World War ended. We have a labor shortage, and we're going to get, you know, not only is the price of things going up, the wages are going up, and so that creates the new challenge. So looking forward, what does this mean for us? I'm in the business of what have you done for me lately? And so we'll bask in the glory of 2021, but what does it mean going forward for next year? And the answer is a little bit uncertain. Money has to go somewhere. So for the next foreseeable future, maybe 3 to 6 months, the US Fed is not going to raise rates to 10% in the next 6 months. They're not going to raise rates to 2% in the next 6 months. They may raise rates 1/4 to 0.5% starting next year, perhaps in the springtime. So the question is, does that derail the markets? Is that going to be enough to really cause the public to start pulling in their assets away from stocks? Money has to go somewhere. So is 0.5% going to be the number that entices people? And the answer is probably not. If the Fed gets very aggressive and begins to raise rates rapidly, this is what happened in 1987. Let's remember in 1987 that the US interest rates for cash were sitting at 3% to start the year. And by August, they had raised rates to 7%. Well, 7 was a pretty good risk-free rate of return. Money fleed stocks. Again, there wasn't a recession. What market wasn't forecasting a recession. It was just the money had to go somewhere, and 7 seemed pretty good. The stock market crash happened in 1987, and the funds began to flee out of cash again back into stocks, and the market recovered fully by 1988. So for the time being, there are, and I've said this before, there are exceptional valuations within the market, and our job is to find those bargains, collect dividends, and be patient, and let the valuations, let the real world discover our discoveries, and it doesn't necessarily happen overnight. But we got a lot of good things going on. Next year, we will for sure see a little bit of the markets having hissy fits or meltdowns a little bit on the fact that interest rates are going to go up. The question is, again, how high do they go? For now, our best estimate is that rates have not derailed the economy. I think that if we look historically, interest rates are 1.4 since 1900 in the US, 1.4 above inflation. So inflation is 6.4 in the US. So the question is the Fed going to raise rates to 7.8? Are mortgage rates going to go to 10? And the answer is extremely unlikely. So interest rates are going to be below inflation, which is terrible news for conservative investors that have parked their money in GICs. One thing that you could probably take to the bank is over the next 10 years, maybe longer, 20 years, is that money will erode. Inflation is likely here to stay, and it's here to stay until such time as we go through a late 70s scenario where the Fed says that's enough, inflation is too high. We are going to deliberately raise rates to the point of recession, and which will create a tremendous amount of pain. It doesn't seem to be that there's the language by the Fed. And again, we know that the most important consideration is we don't fight the Fed, but we will watch it. So we're willing to change our minds, but for now, we'll collect our dividends from TELUS or Manulife and collect 4.5 or 5.5% dividends. Enbridge, which is the toll master in the energy space, they just raised the dividend. It's 7%, people. Like it yields 7 times more than a GIC. Again, it's incredible that you can buy these things in an environment of zero rates. And there's so much hot money that was chasing Peloton stock and Zoom video and trying to make fast money, and they sort of forgot about the boring stocks. But the boring stocks have worked out very, very well. We still have exposure to preferred stocks. And as interest rates go up and bonds continue to fall in value, and again, the investing public is completely invested wrong going into 2022. Let's be clear. If I'm right and we're looking at high single-digit returns for the Toronto Stock Exchange or the general markets, the bond portion of those funds, the balance funds, will probably have another 5% year. This year, the balance funds did 8% because the 60% in stocks did 20%, and 40% of their fund lost. Next year, what's going to happen when the 60% does 7 or 8%? You're going to subtract your 1.6% fee, and then you've got 40% of your fund doing -5 again. So that's where we are. I thank everyone for their patience and for their very, very kind words and the fact that they stuck it out. Obviously, if you're still with me, you stuck it out, because if you went to cash, you're fired as a client in 2020, because that was a generational opportunity. Anyway, that's where we are. Marc, I know we had some questions that were, thank you for people emailing in. So Marc, can you take it over from here?
We got actually quite a few questions, so it would appear not everyone's on holiday mode just yet. So picked a few. First one is, we got this multiple times, clients noticing a bit of a sort of shift from what has been historically over the last decade, a very, very small, almost non-existent allocation to Canadian equity to a higher percentage these days. So just want to touch on that a little bit. If you go back in time, kind of pre-08, clients will remember we used to have a significant allocation to bonds. Coming out of 08, where that served us very well, we sort of looked and said, well, low rates is going to be conducive to money flowing to productive assets that pay dividends and stocks. And we looked at the valuations of the US market versus Canada and found better valuations in the US and significantly more breadth in terms of available sectors and business types. And so remembering that Canada is a very concentrated market, materials, energy, banks, we made the determination then, it made more sense to be in the US. So a decade later, in retrospect, that served us very well. US has outperformed, or Canada's underperformed, depending on the way you want to look at it. But at this point, and starting almost a year ago, we sort of noticed that macro tailwind of higher inflation that should be beneficial for Canadian stocks is sort of in place. So we've sort of viewed that as an opportunity to pick up our allocation from, again, virtually very little for the past decade to a higher amount in client accounts. So just want to touch on that trend. The other question, David's talked a lot about debt, inflation. We've got some questions around global debt, things like that. I think the better way we sort of look at it is, well, if that's the case and those things are in place, how do we deal with it as an investor? So David talked a lot about that. I'll give you a little bit of a historical example that I dug into. If you go back to World War II, in 1942, in sort of the teeth of the war, the Fed moved rates down to 0.375%. By the end of the war, we were at a 10-year US Treasury rate of 1.13%, and we'd seen monetary base expansion from 1939 to 1948 of 149%. Effectively, that was your 10-year Treasury rate low. And over the next 35 years, we saw that 10-year yield go from a little over 1% to 15.8%, which was significant bond underperformance. And during that period with higher CPI, cash was also a weak performer. So the trend remains the same. There's a lot of parallels then. A really challenging environment that led to a lot of monetary policy, low rates, significant debt. And the resulting years, you were much better in terms of owning businesses that had the ability to raise dividends and raise prices and pass pricing pressures through. So that continues to be our view as a better way forward. Other question we get kind of regularly is, ESG versus energy, personal preferences and accounts. So just because we've got a big audience of people, ESG is green investing. Okay. Green energy. So we get that regularly around personal preferences. So given we've got a big audience of our clients on the call, just thought we'd remind everyone in our group has an individualized portfolio to some extent. We don't cookie cutter everyone. There's no one size fits all. So to that extent, we can work with some of those preferences. At the end of the day, our job is to create the best investment return for the lowest amount of risk that we can. And so, and everybody tends to draw the line in different places. I think David and I have never owned Philip Morris stock. Maybe we draw the line there. For others, it's energy. For others, it's Coca-Cola if you're a dentist and you've worked with kids' teeth for a long time. So we can work with some of these. Another reminder that we don't operate in new issues. We don't do new deals. And, so if TransCanada wants to build a new pipeline and they need $1 billion and they're issuing common stock, in a sense, if you participate in that, you are cutting the company a check with your money for that particular deal. If you're buying shares on the open market, you're really just buying them from somebody else. So food for thought, but if there are these preferences and you want to discuss them, give us a call. Last thing is more of a housekeeping, just because I know everyone's on the call and I'll mention it because I've had many people ask. As far as TFSAs next year go, the government has announced that it will be $6,000 is the contribution limit for next year. So keep that in mind. They're your best accounts going forward. So 6,000 will be the number next year. I think that's it, Dave.
Awesome, guys. Thank you. Thanks for tuning in. We got a big number of participants, so appreciate that. And as always, if we didn't get to your question, pop us an email, give us a call. I'm going to be away up skiing, but I can be reached. A little Whistler is supposed to get a big storm this weekend. Excited about that. Kids are back. I'm an empty nester. Got the twins are back, so we'll have full agenda there. But of course, I'll got one eye on the markets at all times. Thanks everyone, and happy have a great holiday, and we'll see everyone in the new year. Thanks.